This is Retirement Roadmap Radio with Mark Fricks of Master Plan Retirement Consultants. Listen in as we address your retirement concerns and provide insight to help put you on the path to achieving your retirement goals. And now, Retirement Roadmap Radio.
Hey folks, welcome back and thank you for joining us. Welcome to Retirement Roadmap with Master Plan Retirement Consultants. My name is Evan Fricks. With me as always, retirement planner and investment advisor representative Mark Fricks. We have a fun one for you today. Today we will be discussing investing in an election year. Yes, indeed, folks.
In other words, politics.
Absolutely. We'll try to leave our personal politics out as much
please.
as we possibly can. But we do have a lot of data to go through and discuss the volatility of a market during election year. We get that a lot. As Americans are preparing for the 2024 presidential race, so what are the investment implications of an election year? With diverging views on Social Security, ESG policies, taxes, and retirement, the next president could impact investing planning decisions. A question that we've been getting more and more this year: how will the 2024 election affect the market? Or, as far as our clients are concerned, how are they going to affect my money?
Yeah, almost every client that I'm meeting with is like, so give me your take on the election, who should get elected, where does the market go? So we thought this was a very appropriate subject for today, and we've done, Evan's done some great research too, as well as what the market does and doesn't do, and I've got my own opinions too, as always.
Well, with Trump leading the polls for the Republican candidacy, the election is shaping up to be a repeat of 2020. We've got big policy promises, the political rhetoric that seems to follow Trump around. These concerns could lead to short-term market fluctuations. They tend to drive investors to less risky vehicles. From 1992 to 2022, average flows into money market funds increased in the year up to and the year of the presidential elections. Are we seeing that on our end?
I'm not really seeing that yet. And I think it's because we're coming out of a bear market. And now I don't know what the average investor on the street's doing, but as far as our clientele, which is pretty good sampling, right? They do kind of ask a little bit about should we reposition for this election or whatever, and I don't think so. I really, even though I know stats tend to lean more toward that way, but I think that's more people that are exhibiting fear as opposed to thinking correctly. We've done shows on emotional behavior, investor behavior, things like that, and so I think most of the people you see that are moving to money market are not using maybe logical numbers or algorithms, but I think they're saying, I'm going to sit this out for a while.
Yeah.
And I don't know that that's a great idea. If you've been sitting out the last 6 months to 9 months, you've missed some really nice growth, and certainly I'm not predicting the future, but the numbers are there, I think, to have a strong market. But again, we're going to relate that back to the election too.
Yeah.
But I don't think you just need to move to cash. Hey, if you're scared to death, either get an advisor that will help guide you, or move to cash. It's kind of your money type of thing. So it's hard, and it would be horrible if I say stay in the market and the market dropped 20, but that's just not what the numbers are telling us.
Yeah.
That's what we have to look at.
Well, the past couple of election years have certainly seemed bombastic with the rhetoric and just so many things going on, the candidates going after each other.
It's become just a madhouse.
Absolutely. And so when you see that as the layperson or as an outsider, you see that and you just assume that everything is going crazy. You assume that everything is going to be volatile, but actually the numbers don't reflect that. I want to read a couple numbers off real quick. So while there may be increased caution when investing during an election year, the impact on the long-term investments, first of all, is minimal. But as measured by the Chicago Board Options Exchange CBOE Volatility Index, or the VIX, the market volatility ended 2020 at 22.75, which is only a little bit higher than the historical average of 21, even as the world was recovering from the COVID-19 pandemic.
Yep. And does that include also the Ukrainian conflict, the war in Russia? Does that through that time period?
No, that would be slightly after this time period.
Okay.
Yeah.
So it'd be interesting to see what that is. But yeah, it's again, the VIX. I watched that a good bit, and it's very interesting to see the fluctuations as it relates to politics and nowadays with politics, it's about court cases, right? whether it be Trump being accused of something, whether it be him trying to get on a ballot or whatever. It's like news every day when it comes to that type of thing too. Is he going to be on a ballot? Is he not? So it certainly, I think, adds another layer. I think we're in a little bit new territory, but it's very interesting. If you go back to history, I'm talking about 100, 150 years ago. These politicians were just as vicious as they are today, and they were there were people talking about getting out of the Constitution, and they're running on really wild things. I saw the John Adams, I think it's like an 8-part series a year or two ago, and did not realize how teetering our country was in the early days, and even into the Civil War. So it's I don't want to say there's never anything new. It just might have a different flavor, but it's still very much, you look back and part of investor behavior, as we've talked about, is the way it is today is the way it's always going to be. And that's not true. If it's a bad market today, that doesn't mean it's always going to be a bad market. And same thing with good things, same thing with politics and elections. I'm hoping this country settles down some, but in the meantime, like we're talking about today, what has been the trends and what can we look forward to?
Well, I want to throw some numbers at you real quick. We'll try to not make it too boring. But we want to take a look at the past returns in election years. This is quite interesting. So over the last 40 years, there have only been 2 election years where the S&P 500 posted negative returns. 2008 during the great financial crisis, and 2000 during the crash of the dot-com bubble. So in fact, I want to run through some of the past years, and these are just the election years of the S&P 500 returns. And we're kind of look at these numbers a little bit and see how our presidents did on their election years here. Okay, so 2020, Biden, the S&P returned 18.4% on his election year. Trump in 2016, 12%. 2012, Obama's second term, 16%. 2008, Obama. Okay, now here, this was also during the global financial crisis. 2008, that was a negative 37%. We felt that one. 2004, Bush's second term, 10.9% return. 2000, now this is the dot-com bubble, negative 9.1%. That doesn't seem too bad anymore, does it?
No, and really, I think the issue with that is I think a lot of those numbers are driven more by kind of like a change or a president's coming in, because if they're coming in, so they've got 1 year. So they start office in January. So that first year of being elected, they really don't have time to get principles in place, to get policies in place. I mean, they might sign a few executive orders, but I don't know how much of an effect they really have on that first year of the stock market. And I think a lot of that may be driven by the fact that, hey, we have new ideas. They made a lot of promises, and things like that. But without really implementing their entire policy administration, I think that first year may mostly be the newness of the people coming in.
And layover from the previous policies as well.
Perhaps as well, absolutely.
Looking back a little bit more, 96, Clinton, 23.1% return. His first election year, 1992, 7.7%. Bush in 88, Bush Sr., 16.8%. Reagan 84, 6.3%. Reagan 80, 32.4%. So why do we say this? So here's some overall looks that are kind of interesting as well. So from 1928 to 2016, the total returns for all election years, 11.28%.
I want to stay invested.
That's not bad. No, I mean, again,
it's above the average.
I want to reiterate, we see so much just craziness thrown at us in the media. We've talked about this before, so much of it. That's how you get clicks. The crazier you are, the more likely you're going to get the attention, the squeaky wheel, right? That whole thing.
I think it'd be interesting to look at what the markets did the year of the election or the last year of that president. That would be interesting to look at. Like this year, the markets are up nicely, and we're heading into an election. So I'll kind of give you my opinion. I know you're going to get into this a little bit more in a few minutes, but I think that who gets elected has very little impact on the stock market. I think it's the markets. The markets are going, okay, they're elected, okay. Markets don't like uncertainty. So I think once somebody's in place and, they just kind of ignore it, I think, at that point, except depending on what policies they do put in place, especially extreme policies, positive and negative. I think when President Trump did the Trump tax cuts of 2017, part of that was he lowered the corporate tax rate. Well, that certainly inspires businesses to reinvest, hire more people, produce more products because they're putting less money into taxes. So I think that had more of an effect than Trump being elected type of thing. So I do think it's the policies and things. And so I think that first year is more about maybe some excitement about we got new ideas. They're talking good stuff.
Yep.
Let's see what happens.
Absolutely. A couple more quick numbers for you. So S&P total returns, we said over all election years, the average return was 11.28%. Not bad. Republicans, average of Republican return 15.3%, and Democrats 7.6%.
Okay, well I'm done then. I know. No, I'm just kidding. I'm just kidding. No, that's interesting. Then I wonder that'd be interesting to figure out why of that. Is it just luck? Was it just happen to be the time of year or the particular year in the market or what? That's an interesting. I've not heard that.
Or
stat.
who they're replacing.
Yeah. Well, that's eye opening for me, by the way.
Yeah. So a little bit more, digging a little bit deeper into the entire 4 years of a term. So recently, President Biden released a video showcasing returns where since he was elected, and he kind of mocked President Trump over the market performance compared to his. We know that market returns matter to voters. Many view the stock market as a gauge of the country's economic health. Whether or not that's true is a deeper conversation, but it matters, and it's, of course, used as a talking point. However, we take a closer look, and we see that the returns during Trump's 4 years actually outperformed Biden's 4 years. So while the S&P gained 37.4 during Biden's first year in office, which in fact was the best one-year market return under a president since Harry Truman in 1945, the country was amidst an economic recovery following COVID-19. Then in 2022, the S&P 500 dropped approximately 19%, the most significant annual drop since 2009. Since Biden took office, the market has risen 25.9% overall. However, during a similar period for Trump, the return was 42.3%, while former President Barack Obama, in fact, bested both of them with a gain of 48.6%.
Again,
So,
that's why I say the politics, I don't really think you can drive the market with the politics. And I can tell you right now, the people on Wall Street, they'll tell you, okay, I'm watching it, but I don't really care. I want to know if this company's making money or this one's not, type of thing.
right. So,
but I still love the trends.
Oh, absolutely.
Really interesting.
And I think you're right, too, when you say the market, we know the market is driven by so many other things. I think the policies have way more of an impact than the election year itself. Yeah, we have the volatility, like you said, the newness, the anticipation, the caution, but it's the policies during the presidency.
Well, and it also would be interesting to see what Congress was like during these terms. Was it more of a Democratic Congress, more of a Republican? Was it a mix? Because if it's leaning heavily one way or the other, they can get more things done that the president wants done. Unless they're the opposite side, then he can't get anything done. And so how does that wrap into all this? Because, Congress is the one that makes the laws. The president supposedly drives a lot of those policies, but sometimes they don't have the power to do that. So then you start wrapping those numbers in. And right now, of course, we're very evenly split. So what happens there could have some effect. Again, though, I think it's still going to be so close that it's still going to be continued stagnation in Washington, which the stock market's kind of fine with. I mean, no big changes means we can just watch the economy and the companies that we're following and let them play over here, in their sandbox, so to speak.
Absolutely. Folks, I want to take a quick moment to point you out to our website, masterplanretire.com. You can find links to these episodes. You can find retirement resources, as well as a link to Mark's calendar to schedule your complimentary consultation. That's an opportunity for you to discuss your own retirement with Mark. We'll run some reports for you, give you a 10,000-foot view of your own retirement, get a better understanding and idea of where you stand. That's masterplanretire.com. Feel free to call us at our office as well, 770-980-9262. I want to discuss market seasons a little bit and compare a normal market year to an election year. Historically, in a non-election year, the market tends to start and end the year on a high note. Performance typically slips in the middle months in the summer, typically the third quarter, which is July to September. Those usually have the worst results. Election years, however, historically, the market tends to get off to a shaky start in the first quarter, but builds momentum through the rest of the year. So what does that tell you?
And I think typically what you see, and this is not a typical election year, but typically what you'll see is where in January, February, March or so, we're not really sure who the two people are going to be that's going to run. And they may not settle out till March, maybe April or May, depending on the primaries and things like that. But usually we have a pretty good idea by the third, fourth primary, which is usually done late February, early March. This year, I think we were more certain early. So we had a good start to the year. All the polls were Trump was way ahead, Biden's way ahead. But now I think we're getting a little bit of uncertainty because is Trump really going to make it all the way to Election Day? Yeah. There's so many different things coming after him. Many of his making, maybe some not. Is he guilty? Is he innocent? That's for everybody else to decide, or at least the juries and the judges. But I think strong start this year. Last few months more volatile, a little flatter. Again, I think people aren't sure who's going to be running 100% sure. And then you have the Biden question. There's been a little bit of scuttlebutt out there. Is he going to back out at the last minute? Or are they going to ask him to back out? There's a couple of people in the shadows that they may have lined up, to run. So with his age and his frequent misquotes and information that he doesn't quite remember correctly, and the oldest sitting president as well. So I think both sides, there may be a little bit of doubt. Are these really the two people that's going to end up running? So we felt better at the beginning of the year. I think we feel less. So it's a different kind of year.
It certainly is. I mean, 2024 elections are but one variable in market fluctuations. I mean, we have crazy geopolitical events happening right now. We're experiencing inflation, have been experiencing inflation. Fed policy, investor sentiment, they all have an impact, and especially in volatile times, investors, they function off of emotion. So that's another thing. You see the volatility. Everyone's, okay, I got to get out of the market right now. I don't know what's going on. I feel like the world's going.
The heck in a handbasket.
That's what I was trying to figure out how to say that the right way. So we see that investor behavior affecting things as well. So how do you participate in the market? Do you participate in the market?
Well, so it depends on your age and your risk tolerance. But, if you're looking at the long range, the market grows. The problem we have today is too much information. We have talking heads shouting at you. Their job is to get more commercials, more ads, more people watching. You've got a world economy, so if something happens in Ukraine, it can affect us. Sometimes good, sometimes bad, by the way. If we make more weapons, some of our companies make more money, like Lockheed and companies like that. You've got social media. Used to you had 3 people standing around a water cooler, right? Now you've got 10,000 people talking on a social media about a stock or an idea or whatever that drives people way one side or way the other. So we've seen increased volatility over the last 25 years or so. I think that's going to continue. So that's why you really need a long-range plan. Even if you're retired, you need a long-range plan. You can't go by the seat of your pants. You can't go by, hey, I watched a money show this morning and I watch it every morning and I'm going to make my changes that way. I've had a few clients that have a little bucket of money they like to manage on their own. And it's so funny, they'll have a 2 or 3 year stretch where they're doing great and then all of a sudden they collapse because they thought too much or didn't think enough or whatever. So if you've got a plan, what we call a retirement roadmap, is part of that is that income plan that has a controlled bucket of money, some growth money, but using various techniques that are more computer driven, as we've talked about before, that takes the emotion out. So again, a long-term plan to where we know, hey, yeah, this is going to be bumps. There's been bumps forever, but those bumps don't last forever because this country has a lot of consumers. They have people that won't need to eat. That the people that work, this country is still the strongest country economically in the world, and so you can't say, well, what if the stock market drops to zero? Well, if the stock market drops to zero, we don't have a country anymore. So we got bigger problems than just the stock market. So it's not going to do that. I have so many people, and maybe they misspeak. They go, well, what if I lose all my money? That's impossible again, unless it's an Armageddon situation. So like I said, don't worry about that. But that long-range plan, if you keep your eye kind of on the goal, you kind of miss out on all this riffraff going on around you.
Yeah, I mean, Volatility, like you said, is not going away, and it might even become more volatile as we move into the future. But you participate intelligently. You have someone to help you. If you are in the market, active money management is a great tool. We use that. And it's the long-term view, just as you said. Of course, you don't want to take income from a fallen market. When things drop, make sure that you're allocated correctly, that you don't have to depend on that market for your income, and you can let it ride and get that long-term growth. So a quick note, since the late 1920s, okay, the market is up almost 23,000%. So what does that say? Given enough time, historically, the market has always grown. Some presidents experienced a market downturn during their term, but aside from a few notable exceptions, being the Great Depression and the Great Recession, the market has been in a better place by the end of the president's term.
Right. Yeah, and again, those are isolated incidents. The Great Depression was so many laws have changed since then that would be impossible to happen because we now have buffers on the market. The Fed is doing a better job. We have smarter people in control. We've seen the history of our markets for 225, 230 years, not 250 years going on pretty soon, right? So it's just different times. Doesn't mean we're not going to have bad times. We could have another great recession. But again, if you're playing the long term and you have a plan, you take away, again, you're looking ahead. And yeah, we're going to watch every day as advisors. But we also know that that's our goal. And that's really in retirement, what's your goal? Having your money last a lifetime and making sure you've got enough to take care of those things that we don't expect to happen or sometimes do expect to happen. Anything from tax increases to long-term care needs to family needs or whatever. Be prepared with a fully written plan.
Yeah, have a plan. Don't let your personal feelings or emotions distract your investing plans. The key takeaway is that the market tends to go up over time, regardless of which party is in the White House. Folks, I do want to remind you to check out our website, masterplanretire.com. There you can schedule your complimentary consultation with Mark, opportunity to discuss your own retirement, masterplanretire.com. Mark, any parting words for our audience today?
Yeah, so one of my favorite things is doing initial consultations. That's when somebody schedules and says, hey, I want to chat with Mark by phone, by Zoom, in person or whatever, but it's that initial introduction to where I'm able to hear your story. I'm able to hear your concerns. What am I worried about? Should I be concerned about this? Am I going to make it? And we have that discussion of goals and dreams and concerns, and then based on your wants and needs and what fits as being fiduciaries is we will run a series of reports, still complimentary, 6, 7, 8 reports to show you where you're at. And can you get where you want to be, and what will it take to get you there? So make sure you schedule that. It's complimentary, and it's easy to procrastinate that, but click on that button, masterplanretire.com, schedule a meeting. You meet with me, and we'll probably have some fun doing it. Any last words?
I'm going to give that one to you.
Okay, so remember, plan well and prosper. Take care, everybody.
This was Retirement Roadmap Radio with Mark Fricks of Master Plan Retirement Consultants. To schedule a complimentary consultation, go to masterplanretire.com or call 770-980-9262. Thanks for listening, and remember, plan well and prosper.
All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Advisory services offered through Master Plan Retirement Consultants, a registered investment advisor in the state of Georgia. Mark Fricks and Master Plan Retirement Consultants are not affiliated with or endorsed by the Social Security Administration or any other government agency.